government made a startling announcement. The country didn't run out of money. It intentionally invalidated it overnight. Through a process called demonetization, the state instantly erased the vast majority of high-value cash, specifically the 500 and 1,000 rupee notes, from public circulation. The official reasoning for wiping out 86% of the nation's currency was highly specific. Authorities targeted counterfeit bills, targeted shadow economies, and black money. Black money refers to income that is illegally obtained or not declared for tax purposes. When physical cash dictates how a nation trades, those transactions become invisible to regulators, leaving the system highly vulnerable to misuse. But capital naturally flows through the path of least resistance, routing itself through massive informal networks and cross-border channels entirely outside the traditional banking system. The Khanani brothers perfectly illustrate how these parallel financial systems operate. The Khanani organization was a sprawling international money laundering syndicate that moved billions of dollars globally for criminal groups. Operations like this handle staggering volumes of physical currency across international borders, and they do it completely undetected by regulatory authorities. When immense portions of an economy function entirely in the dark, the state loses its ability to track wealth. This lack of oversight transforms a standard economic risk into a severe systemic risk. The 2016 policy directive was designed to forcefully extract hidden wealth from the shadows and push it directly back into the regulated banking sector. By legally mandating the return of these notes, the government aimed to establish absolute traceability over the movement of the nation's capital. The physical result was immediate and chaotic. Hundreds of millions of citizens flooded local bank branches, desperately attempting to legitimize their suddenly useless cash before the exchange deadline. Striking the currency from the ledger was an aggressive tactic designed to eliminate financial blind spots and permanently re-establish state control over the economy. However, stripping physical bills from the shadow economy triggered a severe mechanical failure. It inadvertently drained essential liquidity out of the entire financial system. Markets do not process policy announcements or political intentions. They react strictly to the mathematical reality of available spendable capital. When a policy decision removes the cash node, available capital for daily spending instantly drains away. Without that spending as fuel, broader economic activity is starved of input and comes to a grinding halt. In their pursuit of perfect financial surveillance, regulators accidentally suffocated the exact mechanism that allowed the free market to function in the first place. This type of liquidity crisis does not trigger blaring alarms or cause the immediate, cinematic crashes associated with Wall Street panic. Instead, the symptoms appear as a slow, quiet erosion. Financial flows thin out, investors lose their appetite for risk, and consumer confidence steadily deteriorates. The market begins adjusting to this restricted, low-flow environment, absorbing the ongoing stress as a steady, mounting pressure, rather than a sudden explosion. A market operates as an aggregate of human behavior, and human behavior alters immediately when the means to transact disappear. The demonetization experiment laid bare a vital economic reality. Wealth is not a static object meant to be stored in a vault. Its true nature is kinetic energy and continuous movement. When you forcibly stop that circulation, a cascading paralysis takes hold, choking everything from neighborhood shops to national supply chains. A central bank can mandate the absolute control of physical notes, but it cannot force the economy to thrive in their absence. Ultimately, markets follow the money.